In this video, we're going to look at long-term financial planning. In this case, they refer to something called the pro forma statements. A pro forma statement is quite simply just a projected or forecasted income statement and balance sheet. So essentially what we want to do is we want to start with last year's statements, apply a sales forecast, and then make some assumptions about how other assets react to changes in sales. Now, this is a little bit different, right? Because normally we're looking at statements that are created in a double journal accounting system where debits equal credits, the balance sheet balances, etc. But because we're not using that system, we will frequently not have a balance sheet that balances. And we want to talk about how we deal with that and what it tells us. So let's move on here and think about these statements. So here we have the financial statements for this particular company. This is their income statement, right? How much went to dividends, how much went to retained earnings, so we know their income statement. Here's their balance sheet at the end of the year, so we understand this. We have a sales forecast. So this is what we think is going to happen next year. We predict 1,500 of these things, 1,950 of these. So our sales is going to change from where it was 100,000. Now we're predicting sales of 135. So the question is, this increase in sales, what is that going to require of management in order to sell 135,000 things? There's two questions we have to answer. Number one, what assets do we need to sell these additional units? We certainly need the ones we already have, but we're going to need some more assets. Short term, long term, whatever, we're going to need some more. The second question is, if we're going to get more assets, we need to understand where is the money going to come from in order to buy those additional assets. So that's what this forecast is all about. Let's predict what we think we're going to need on the left-hand side of our balance sheet. What assets do we need to do the business? On the right-hand side, we need to figure out where the money is going to come from to buy the assets on the other side. So we can start to develop what they refer to as the percent of sales method. We're going to assume that there is a relationship between line items and sales. So in this case, cost of goods sold is roughly 80%. EBIT or operating income is 10%. The expenses, interest expense is 1%. So now we can plug these numbers into this forecasted income statement. So now you see sales went to 135. Here are the numbers that we plugged in from our estimation from our previous financial statements. Here's what we think our tax rate's going to be. So again, we know that net income is now expected to be $10,327. We're going to pay some dividends, right? Are they the same dividends or more? We can decide what we want to do there. And then the remainder goes to retained earnings. So that is profit that goes into buying new assets. So what other kinds of things do we have to review, right? First of all, are all of these costs that we talked about, are they all variable or are some of them fixed, right? So the best way for us to adjust, right, again, is not to worry about the debit credit system, but we can again put in historical changes. We can break things down into fixed and variable components. But for the most part, we don't need to do this so much with cost of goods sold. But it is important to understand that maybe changes in interest, right? Maybe changes in dividend. Maybe those are things that we want to change. So now we go from, here's our actual income statement. Here's the new income statement. So we have this pro forma income statement, but in this case, we broke things down into variable and fixed costs. Again, from the usual financial statement that you and I see, we can't do this, right? We don't know what those ratios are here. From inside the company, we can do this. So this would be what inside the company you might see, but outside the company, it should be something different. Now, the other thing, obviously, we need to do is we need to, again, understand if everything is fixed, how are we going to develop our overall statement? Again, as long as we're always doing the same thing, right, we'll be able to make some consistent decisions over time as we develop these statements. Now, what about the pro forma balance sheet? Again, we're going to use a judgmental approach. Some things we're going to assume will adjust directly with sales. Maybe some other things don't. But in the end, we're going to try to develop a projected or expected balance sheet moving forward. So what assumptions are we going to make? The company has a minimum amount of cash that they want. Marketable securities, those aren't going to change. Accounts receivable. Our average sale on day is about 45 days. So the annual sales projected, since we have 135,000 expected sales, we're going to average around $16,000 in accounts receivable. We're going to do the same thing with ending inventory. We know how much of it's raw materials, how much of it's finished goods. Again, all of this information is a lot more relevant and attainable from within inside the company. Again, all of these numbers are going to be applied to the current financial statement so we can predict moving forward. Again, we're going to have to predict things like accounts payable, right? What are the taxes that we have to deal with the company? Notes payable, right? Retained earnings. We already decided we're going to understand. We know what that's going to be because we did that when we predicted the pro forma statement. So what we end up with now is we have a new financial statement, right? Here's the accounts receivable as of December 2020, what we expect to happen with total liabilities, right? So here is total inventory, 16,000. There's total liabilities. Let's look at the rest of the balance sheet. What we're going to find out is we have total assets of 105,000, and our debt side, the right-hand side of the balance sheet, is only $97,000. So again, here's what this statement tells us. We know that we need $105,000 in assets on the left side. So we have to have gathered $105,000 to buy that. We don't have enough money to buy all the assets that we need for these new assets. So this provides us with what's referred to as external financing required. We're going to have to go out and gather another $8,293 in order to purchase these assets. So where's that money come from? Number one, let's look. It is external. How do we know it's external? Because we've already adjusted the profits. Retained earnings, we've already adjusted that. So profits have already been reinvested. There's not enough to buy all the new assets, so we have to go outside the company. Do we borrow or do we issue common stock? Later videos, we're going to talk about this decision. How does management decide what percentage of this money should come from borrowed funds? So the major weaknesses of this is in the nature of our assumptions, right? the past financial performance will probably not be identical. Some assets, we can force them to be certain numbers. Is that a good idea? So again, how we make these assumptions, and ultimately the assumptions we make, is actually the major weakness of this approach. No matter how we prepare them, though, we have to understand how to use them, right? We can use this to look at and create ratios. If we create financial statements, we can calculate ratios. So we can understand, what do decisions made today, how do those decisions affect ratios tomorrow? How do we apply that? How do we utilize that? Cash inflows and outflows can be evaluated using our cash flow statements. But additionally here, we're looking for long-term types of financing. Let's say every year for the next 4 years, we need to get more money. Let's say we need $100 million over the next 4 or 5 years. Let's say it's just 25 million a year. Should you borrow 25 million a year, or should you say, look, it costs money to gather funds, right? We have to pay to get money, right? Should we just get 100 million this year? We'll use the 25 million this year coming up. The other 75 million, let's put that in an account. Hopefully it grows with some interest, and then we'll withdraw money from there as we need it over the next couple of years. That kind of planning is the planning that businesses need to do, not for short-term planning purposes, but for the long-run life of the company, right? We need to plan for the future. Again, I hope this video was good for you. I look forward to talking to you soon.